Hello and welcome everyone to our monthly discussion. Today we're going to talk about inflation. Is it transitory or not? We'll also talk about unemployment numbers and GDP numbers. We're going to also mention a little bit of the current discussion that the Fed has been having, and then close it off with a planning tip, again, due to inflation. So let's start off.
Great, thanks. So we'll start with inflation today, since that's kind of been the hot topic these past few months, and it's kind of coming more and more to the front page news per se. So typically we say that healthy inflation ranges between 1.5% to 2.5%. And inflation is healthy if it stays in that moderate range. We worry if it's kind of less than in a deflationary environment, or if it's over in more of a hyperinflation environment. And the news right now is worried about the hyperinflation. So there are two different targets that we've seen historically. In 2012, Bernanke came out with an explicit target of 2%. And as recent as last November, Powell amended that to an average inflation of 2%. So Jared, you want to kind of discuss the difference there with the average?
Well, the goal under Bernanke was to have a stated 2% target, meaning the market would know if inflation was above 2% that the Fed was going to tighten, and if it was below, that the Fed was most likely going to stay with easier money. And now with the COVID quarter, March, April, May, compared to last year, inflation numbers are dramatically higher, which is why the Fed moved toward more of an average inflation. But the trouble is, when does the date begin, right? Average could be for a different period of time, and it's hard to tell. If you start from one period when inflation was low, the average number, if you look at this chart, so for example, if you look at the average starting in May of 2009, when there was negative inflation because of the financial crisis, and you average that over the last 10 years, you kind of get that blue dotted line, could be much lower. So it's going to be hard to figure out what the Fed is going to mean by average unless they explicitly state what period of time it'll be for. So it's going to be something to watch for ahead.
Mm-hmm. And then the benefit of that update is that, yes, this number right now looks a little bit intimidating since it's such a higher spike, but when it's averaged out over those periods, we don't have to worry so much about it being over or under 2, as long as that average kind of comes back to the 2% or the 2 level over time. So that's somewhat the difference. Vanessa, do you want to go a little bit deeper on that?
Yes, let's look at the components of the CPI itself. And I think this brings us back to, what do they mean, right? So we're basing everything off of Fed's statements. And one of the pieces that they talk about is if it's transitory or non-transitory. And just like mentioning inflation being average or exact numbers, I think it ties it right back to these components. So we have food, energy, shelter, commodities and services, right? The bottom 3, shelter, goods and services, make up about 80% of the total CPI number. So this is where we focus a lot of attention, just to see the movement in those 3 areas. But if we're trying to think back on what is and isn't transitory, we think of, let's give an example on goods. Something that's included in goods are auto sales. We've seen that used car sales have gone up about 21%. Now that's an extreme, but then we think, is it transitory or non-transitory? And I understand that this kind of ties to the demand of chips and the lack of supply that we have right now of them. So what is transitory? Is it short-term, and what does short-term mean? But a specific example would be shelter. Jared, talk a little bit about leases.
Well, one of the reasons we thought that the CPI wasn't going to be high is if you look at the weight of shelter, which is mostly rents, is 33%. And historically, rents have been between 1% and 2% increase. So if that's a third of the index, likely there wasn't going to be a huge increase in CPI. But look at that April number, is double, almost double what it normally is. And when you think about rental terms, that's usually at least a 1-year lease. So it's not likely to change. These higher prices are locked in for a longer period of time. So that it's going to be harder when we look ahead to argue that the inflation over the last few months is going to be transitory. A lot of this is feeling more and more that we're going to be at elevated inflation levels for some time ahead.
I think we've mentioned a few times as well how housing, where rents are included in CPI, but then not the sale of properties and those values, those aren't included in the CPI numbers. And we've seen the drastic move. So if we look back year over year, closing in April, the housing prices are up 19%. That is the highest increase since they started tracking these numbers in 1999. So that is a huge increase. And of course it is because of the lack of supply. But even the stories we've heard from our clients, Megan has a few.
Mm-hmm. Yeah, we've had quite a few clients in different kind of hot spots of the US where the markets are moving well ahead of even 19% and in a given year. And when you bring that back to the average for the nation, which is roughly 3.8%, you can see kind of how drastic that is. And we're talking about markets that are between 30 and 50% in 1 year. It's obviously something that can't maintain at that level, but getting into those markets, if needed, is somewhat impossible. And if they don't kind of keep at that pace, then it could, hurt those people investing in the long term.
And a second derivative of what you're talking about, Megan, is insurance, right? So there's been a lot of data recently, and as we look ahead of more inflation, if you just think about housing prices being up, and we've talked about lumber and copper replacement costs of those homes being up, and same with cars, right? So insurance to replace what we already own in auto and homes is only going to go up. So our insurance premiums ahead are going to be higher. And that's just another extra measure of inflation to watch for that you will see in the months ahead.
Very true. And kind of bringing that to another growth story would be the GDP. So this past quarter, they just reported a 6.4%. I'll pull up a graph so we can kind of see what that looks like. But a lot of people were stalled in their tracks when they saw this number, just because it's much higher than the target, which is roughly between 2 and 3 for a year. So 1 quarter of 6.4% growth is a little bit intimidating. But if I kind of deduce this for, if you look last year, the amount that we dropped and the amount we recovered, you can see that the year basically ended flat. So if we're looking at this 6.4% growth to factor in last year's growth as well as this year's growth, that could be somewhat normal and somewhat healthy. The targets right now are expected to land between 7.5% and 8% through the end of the year. But do either of you think that it could be much higher than that?
And one extra thing to point out there, Megan, is the second graph, right? So in nominal, so not adjusted for inflation, we're at all-time highs. But the graph just below, which is the concern in everybody's mind, is we're still below inflation-adjusted GDP, which is interesting to look at. And these are the challenges ahead. In absolute terms, our wealth is higher, but adjusted for inflation, our purchasing power is less than it was a year ago. And as we look ahead, is if GDP does grow like expected the rest of the year, closer to 8% for the entire year, this is where we could see more inflationary pressures ahead as the economy is larger and there's more money chasing fewer goods, right? And that's going to be the continued supply chain challenges to watch for if we see the growth that's expected the rest of the year.
Mm-hmm.
And if we remember back, there's 2 key points that the Fed was looking at. One of those is that average around 2 to 2.5 for inflation. So it's an extended period that we have to continue to wait for inflation to kind of stabilize itself. But then at the same time, there is another key item that they're looking at. And this number hasn't risen as fast as they would like. So let's get a little bit into unemployment.
Yes. So another thing that Vanessa alluded to was the Fed has two mandates. One is to stabilize inflation, and the other is to maintain a healthy level of unemployment, which is higher than the level that they want, their target that they want to get to. So there's a few things that obviously triggered high unemployment. One being the massive pandemic that a lot of us lived through last year, and people were laid off because companies were trying to just kind of stabilize their books. So now that some of that immediate scare is starting to simmer down, we're seeing a lot of workers go back. But this most recent figure that was reported was well below the target that they estimated of 1 million. So April's number came in at 266. And a lot of people were starting to speculate that this could be a bad sign, but there's a few things that we still have to factor in. As states reopen, we should see that number come much higher with states reopening and people needing to get their workers back. And companies are starting to be more competitive with their benefit packages for employees. So they're competing not only on the price to bring an employee back for the salary, but also just different creative benefit packages for people who might still need to work from home for a period of time with young children as the schools continue to stabilize. So we should see that number continue to get closer to par as a lot of the states continue to open back up. And another figure that, or a factor that kind of caused that large spike was with the regulations that came out last year with the enhanced unemployment benefits. Along with that, they lacked some of the requirements to apply for unemployment. And one of those was they invented the gig unemployment. And it was for Uber drivers per se that, you know, when we were all at home, they didn't have work to do as well. So it relaxed a lot of the contract workers to be able to apply as well. So as the world reopens, they should be able to get back to work as well. And some of those enhanced regulations might fall off as well with the enhanced nominal benefits.
So with all this growth and looking at, we were talking about, Megan, with unemployment, it's just going to take time for the economy to reopen and people to get back to work. The Fed, in our view, should be talking about tapering. So in the Fed minutes last week, tapering came out that they'll think about tapering in the meetings ahead in the next few months. And the immediate reaction in the stock market was to kind of move back toward growth assets and away from the inflation protected assets, whether it's value, dividends, or commodities, right? And it's again, to use the transitory comment, is this a transitory trend in the markets that we're chasing this in the short run? Or is this a longer term trend back toward inflation? Right, the immediate reaction, in our opinion, is more transitory, where computers bought tech and growth stocks and sold or rotated out of value and dividends for a couple of reasons. One, I think we all agree that ahead we're going to continue to see more and more inflation, and this is much more of a permanent, higher, elevated inflation than short term. And then specifically in the tech, which has started to come out in the most recent earnings reports, our compensation costs are going to go up a lot. And one thing to watch for, especially in much of the tech sector, are option compensation costs, right? So companies tend to give employees options that are much higher price than where the stock's currently traded, and they vest over many years. So what you're going to see is employees exercising stock options in the quarters and years ahead, and that's going to be a much larger charge. It's dilutive to the existing stock. It's cash flow that the company needs to buy back stock to maintain earnings per share. And as we are in this inflation cycle, it tends to favor, again, the value and the commodity names as we look ahead. So these are the factors we think that short term, with the Fed using the tapering comment, will likely switch in the weeks and months ahead back to the longer term cycle.
Agreed. And I think this brings us back to what are we doing to make sure the investor is protected throughout this time, right? And thinking in a planning aspect, there's two pieces that need to be watched: your investment planning as well as your financial planning. And I know those tend to seem similar, but there's allocations around investments that, taking advantage of inflation, there's definitely opportunities out there with your allocations that we are taking into account by picking what to put in your portfolio depending on your risk tolerance. But then at the same time, now that we have this inflation factor, if we think back to our conversation about CPI and its components, housing, right? There has been reported that some people have paid $1 million over asking for their property.
Mhm.
That sounds crazy, but it's happening. It's happening to many people. Whatever they're asking for, it's at least 10, 20% higher than that is what the actual property is going for. There's bid wars every day now for properties. So why is this important? This is important because then you have to analyze your current situation. So if we've sat down in the past and you've said, hey, this is what I'm thinking, I'm going to do 1 or 2 family trips a year. And when I'm ready to retire, let's say mid 60s or early 70s, I want to buy another property in this state, and I want it to be for $1 million, let's say. But now, after the pandemic, if you've decided to change maybe your lifestyle or change your opinion as to how much you wanted to spend, even though your financial plan does account for inflation, it's not going to account for a whole different lifestyle.
Mhm.
So this is where it's really important to kind of tie it back to, have you made any changes within your family as to what you want your future to look like?
And again, a lot of this is key with where interest rates are too. So that the Fed is going to change interest rates ahead, but probably still not for a few more years. So if you're too conservative and you've changed your mind because of the pandemic and want to spend a little bit more, enjoy more of your money, or that second home is going to cost a lot more, these are factors that we need to update your thinking and the asset allocation overall. So it's doable overall, but it's back to the communication that we like to talk about. The more you communicate with us and update your plan and estate plan, the better you'll ultimately be in the long run.
Agreed. Well, that's all we have for you this month. Reach back out to us if you have questions or you'd like to make adjustments. And thank you so much for listening.
Thanks.
Thank you.
Bye.